Okay, folks, welcome back. This is price action model number 2, short-term trading plan. 50 to 100 pips per trade. Alright, so ICT price action model number 2, short-term trading model. And again, the objective is 50 to 100 pips per trade. As I warned in the first price action model, majority of the slides you see in these trade plans are going to be repetitive. So please avoid sending me emails. There are differences. You just have to pay attention to the logic that's being submitted in each one. The process, obviously, for every trade plan is we go through a preparation stage, an opportunity discovery, the trade planning, trade execution, and trade management. In the preparation, we always refer to the economic calendar for the coming week, noting all medium and high impact news events for the markets that we intend to follow. We study the events on the week to come and consider how the current market structure and the calendar events may suggest a specific weekly profile for that week's range. In a simplest way of describing this process, what we're doing is we're looking for a collection out of the weekly templates that I outline that are bullish when we're anticipating the market to go higher. And by comparing the bullish templates with that of the calendar, you can match up what the likely weekly profile is going to be. Now, it's not going to be 100% based on just that, because there's always a variable, but that's what I do. I go in and I look at, if I see a high impact news event that's really centered on Tuesday, London Open, then I'm going to be looking at the Tuesday low of the week weekly profile, and or the Wednesday low of the week weekly profile. Alright, so we're going to be looking at the preparation. We're going to be determining the IPTA data range for the last 20 days. We do not count Sundays. We note the highest high and the lowest low of the past 20 days. And this is going to be your current dealing range. So if today is whatever date it is, we're going to look back 20 days from today. And whatever that trading day is, that is your 20-day ago look back. We're determining the highest high and the lowest low, and that is our dealing range. Now, you're going to sometimes encounter periods where you may require looking back 40 days or 60 days when you have really no PD arrays to choose from in the last 20 days. In other words, if we've already worked inside of the last 20 days dealing range, both up and down, then you would use the look back of 40 days. And if the same thing, if we have nothing in there, we've worked both directions, we go back to 60. If you can't find anything in the 60-day look back that's clear and logical, then you're going to have to choose another market to trade or sit on your hands. Inside this dealing range, we look for the next draw on liquidity. Where is price likely to trade to next? An old high, low, fair value gap, or liquidity pool. We look for a PD array in the direction of the weekly range bias, premium PD arrays when bullish, and discount arrays when bearish. We anticipate price to move to a PD array that would support our weekly bias on a day and economic calendar event found on the economic calendar with the current or next trading week. This is what we're waiting for. Every time we sit down in front of the charts, we have that in mind. We're not looking for something to magically pop up. We're going in looking for something that would fit that narrative. If it doesn't present itself, then we have no trade. Now, this can either be a run on liquidity or a rebalancing of inefficiency in price. Opportunity discovery, identifying the discount arrays under Tuesday's European opening price. inside the 20-day IPTA data range when the bias is bullish. We identify the premium arrays of a Tuesday's European Open inside the 20-day IPTA data range when the bias is bearish. We identify the discount arrays under the Wednesday's European opening price inside the 20-day IPTA data range when the bias is bullish. And we identify the premium arrays above the Wednesday's European opening price inside the 20-day IPTA data range when the bias is bearish. Now, what am I stating here? If the signal or setup doesn't form on a Tuesday, we still would consider it on a Wednesday. All right, trade planning. When the market is primed, we want to look for a convergence of both manipulation in price opposite to our trade bias at a time that the economic calendar suggests a volatility injection will likely unfold. What we're looking for is some snappy, sharp price movement that would be in the opposite direction, trading into our predetermined level of entry. Basically a Judas swing. Okay, so we're going through a period of market protraction that's opposed to our trade direction moving in profit. So in other words, we want to see it shoot up when we're looking to go short, and we want to see it shoot down when we want to go long. We're not chasing price. We will short above the European opening price and buy below the European opening price. When we are bearish, we will frame a short entry when the price has moved up into a 15-minute premium PD array that converges with a standard deviation of no more than 3 standard deviations. Now, the +3 there indicates that if you're using the Asian range, if you're using the central bank dealers range, or if you're using flout, you're only going up 3 standard deviations, nothing higher than that for your entry. During London Open or New York Open, the setup will typically form. The market will likely create the weekly low during the Thursday New York session. For a time filter and targeting purposes, we will anticipate the trade to pan out until that time. When we are bullish, we will frame a long entry when price has moved down into a 15-minute discount PD array that converges with a standard deviation of no more than 3 standard deviations lower. In other words, we would look at nothing lower than 3 Asian range standard deviations projected lower, or 3 central bank dealers range projected lower, or 3 flout levels lower during London Open or New York Open. The market will likely create the weekly high during the Thursday New York session. For time filter and targeting purposes, we will anticipate the trade to pan out until that time. When we are bearish, we will target the sell side liquidity below an old daily low or fair value gap inside the 20-day IPTA data range, converging with a negative or projected lower standard deviation. What am I saying there? If we're short, or if we're getting ready to take a short, what is our targets? We're trying to predict the Thursday or sooner range that would offer 50 to 100 pips. Our target has to be in the form of a discount array if we're bearish, and we're looking for a standard deviation lower that converges both with standard deviation level and the discount array within a 5 pip variance. The immediate or next logical discount array will be the initial objective. There will likely be multiple old daily lows inside the IPTA data range, but we will use the one that frames the potential for at least 50 to 100 pips. When we are bullish, we will target the buy side liquidity above an old daily high or fair value gap inside of the 20-day IPTA data range, converging with a standard deviation above. In other words, we're looking for a premium standard deviation. The immediate or next logical premium array will be the initial objective. There will likely be multiple daily highs inside of the IPTA data range, but we will use the one that frames the potential for at least 50 to 100 pips. Trade executions. When we are bullish, we will note the European opening price on Tuesday and filter all longs at or below this price level. We will anticipate a 15-minute optimal trade entry to form inside of a retracement lower during London Open and or New York Open kill zones, or a sell stop raid. When we are bullish, we will note the Asian range high on Tuesday and place a buy stop at this level plus 1 pip after 2 a.m. Eastern Standard Time. Now, this is an alternative trade execution. This is basically buying strength. So, in essence, you aren't technically chasing price, because what we're doing is after 2 o'clock in the morning, the assumption is that we have already seen price drop down. Instead of waiting for price to potentially go lower and give us a loss by trying to catch the low, we can just simply use the Asian range high, put a buy stop there, and let it go. Let it buy us into the move with strength. But it has to be done after 2 a.m. So at 2 a.m. when price starts to drop down, if you're still learning how to project the low of the day, you can get your order in the event. Once it turns around and starts to go higher, you'll let the market seek its own low, and then you'll buy the breakout of the Asian range high. We will anticipate price to have made the low of the day after price starts its decline under the Asian range low and or European opening price. When we are bearish, we will note the European opening price on Tuesday and filter all shorts at or above this price level. We will anticipate a 15-minute chart optimal trade entry to form inside of the retracement higher during London Open and or New York Open and kill zones, or a buy stop raid. Okay, the alternative trade execution when we're bearish, we will note the Asian range low on Tuesday and place a sell stop at this level minus 1 pip after 2 a.m. Eastern Standard Time. We will anticipate a price to have made a high of the day after price starts its ascent above the Asian range high and or European opening price. Now, if we do not get a setup on Tuesday, the things that I've mentioned here for alternative trade executions for both bullish and in this slide here bearish would be the same thing for Wednesday. So we would be using Wednesday's European opening price. So everything we would see here that says Tuesday, we would just replace Tuesday with Wednesday and just repeat the same process. Short trade management. When we are entering a short, we will place a sell limit order on all positions we will execute on with our demo account. We will use the standard deviation and PD array convergence minus 5 pips as our entry price when using the sell limit order. If multiple orders are used, all use the same entry price in the sell limit orders. When we are entering a short, we will place a limit order to take 50 pips as our objective on one position. We will place a second limit order to take 75 pips as our second objective. We will use multiple orders to manage the trade idea. If you capture a 100 pip objective, close the trade and be content. When we are entering a short, we will note the premium array and standard deviation convergence we aim to enter at. We will place our stop loss above this high plus 25 pips. We will not re-enter if the trade stops out. We can monitor it for experience, but no re-entry is taken. One and done. Long trade management. When we are entering a long, we will place a buy limit order on all positions we will execute on a demo account. We will use standard deviation and PD array convergence plus 5 pips as our entry price when using the buy limit order. If multiple orders are used, all use the same entry price in the buy limit order. When we are entering a long, we will place a limit order to take 50 pips out as our objective on one position. We will place a second limit order to take 75 pips out, our second objective. We'll use multiple orders to manage the trade idea. If you capture a 100 pip objective, collapse the trade and be content. When we are entering along, we will note the discount array and standard deviation conversions we aim to enter at. We will place a stop loss below this low minus 25 pips. We will not re-enter if the trade stops out. We can monitor it for experience, but no re-entry is taken. One and done. When we are in profit 25% of our expected objective, stop loss can be reduced by 25%. When we are in profit 50% of our expected objective, stop loss can be reduced by 50%. When the position is at 75% of the expected profit objective, stop must be at break even or above it. Money management. Position size calculation formula. Now, to determine your position size, it's the account equity times R% divided by stop loss in pips. Now, position size is the amount of leverage your trade assumes. Account equity is the total amount in your trading account. R% is the percentage of risk you're willing to take on per trade. And the difference between the entry price and your stop loss is the number of pips you'll use to divide for the result of the equity times R%. Okay, as an example, account equity, $20,000. Risk per trade, 1.5%, or $20,000 times 1.5% equals $300 US. The stop required for the trade, in this case, would be 20 pips. In micro lots, 1K each is 10 cents per pip. 20 pips times 10 cents is $2. And $300 total risk divided by $2 per pip would give us the ability to trade 150 micro lots per trade, or 1.5% of the account equity. Always round down. Okay, same equity size, $20,000, and the risk per trade, 1.5%, or 20,000 times 1.5%, $300. Stop required for this is 20 pips. In mini lots, it's 10K each, or $1 per pip. So our 20 pip stop times $1 per pip, it means $20 is our total risk exposure using 20 pips with $1 per pip leverage. So if our total risk assumption is $300, we're dividing that $20, which would give us 15 mini lots per trade, or 1.5% risk of the account equity. Always round down. In standard lots, 100K each is $10 per pip. So if we have a 20 pip stop loss in expectation, we would have 20 pips at $10, or $200 total risk. So if we had total of $200 per risk divided by $300, we can only do 1.5 standard lots, or 1 lot per trade. Always round down. Mini lots are more flexible. Now, right away, you can see with the model that I've outlined here in the trade plan, we're using a stop loss suggestion of 25 pips. So you would change the stop required to 25 pips, and all of the math here would change. It's not complicated math. It's just you're changing the 20 in this example here to 25, and everything would work out for your math to determine what your exposure would be. If your demo account takes a loss on a trade and it is a full R% that you assumed, drop the R% by 50%, and when the loss is recovered by 50%, you are permitted to return to the maximum R% per trade. If the reduced R% trade assumes a loss, reduce the R% by 50% again until the previous trade loss is recovered by 50%. If you take a series of 5 winning trades in a row, drop your R% by 50%. You are likely to assume a loss eventually, and this will build in equity leveling and reduce the likelihood of a large drawdown. You want a smooth equity curve that slopes or stair steps higher, not a jagged roller coaster with deep declines. Alright, so what you're going to be doing is the same thing you did in model number 1. You're going to be collecting a month or two of sample sets with this trade plan. It's not hard to go through your price action and to see where these price moves have occurred. And if you're unclear about some of the process here, rewatch the lessons on this price action model and the supportive lessons in the core content. I will provide sample sets, but do not rely on mine or wait for mine. Dig into your charts and study what was provided here. Good luck in the trading.